Your asset allocation, that is your mix of stocks and bonds, is arguably the most important decision you'll make relating to your investments. It determines your longer term returns and how much you could lose in any given year. So, should you have bonds in your portfolio? Now, this isn't as sexy as talking about SpaceX, but bonds really do underpin our economy. And for transparency, I don't currently have any bonds, and I'm actually not sure I ever would, which might be an unpopular opinion. So in this video, I'll give you the 1 minute version of what bonds actually are, a cool bond tax quirk, which saves a lot of higher earners a fortune in capital gains tax, and then the bit that probably matters most, whether you should add bonds to your portfolio, and if you do, how to actually do it as a UK investor. And if you're trying to get your investments sorted and you don't know where to begin, I've got a free guide and 30-day course. Chuck your email in on the first link down below. I'll send it over. Right, that's the intro. Let's get into it. In 60 seconds, and this might be a challenge, but what is a bond? At its simplest, it's an IOU. You lend money, usually to a government or to a company, for a set period of time. They then pay you interest along the way. This is called the coupon, and it's fixed when the bond is issued. So a 4% coupon on a £100 bond pays you £4 a year, every year, no matter what happens, that doesn't change. They will then give you your original money back on a fixed date at the end, and that is called the maturity. And the amount you get back is the face value, which is normally £100 per unit or per bond. That is it. That's a bond. Free trade offers gilts, which we'll come on to in a second, but this is how they actually look. So you can see the 2028 gilt currently pays 6%. Who are you lending to? There's really two main groups. Governments. In the UK, bonds are called gilts. In the US, they're called treasuries. And companies which issue corporate bonds. A simple rule of thumb here: the safer the borrower, the less interest they need to offer you. The riskier the borrower, the more they have to pay you to take the risk. There are a few types of bonds you'll come across, and I'll put this info on the screen now. And these types of bonds can also be grouped together inside a mutual fund or an ETF. The one thing worth remembering: bond prices and interest rates move in opposite directions. When interest rates go up, the price of the bond you already hold goes down. That is the seesaw, and it's why 2022 hurt so much for investors, and there'll be more on that shortly. And that's also why bonds matter so much, specifically when it comes to UK gilts, which are government bonds. A gilt yield isn't just a number for investors. I guess it sort of is, but it's also the rate at which the government pays to borrow money. So when gilt yields rise, the government interest bill rises with it, and paying interest on our national debt is already one of the biggest things that our country, our government spends money on. The gilt yield is basically the anchor as well that mortgage rates and your savings rates both hang off of. Now, there is a cool nerdy quirk with gilt specifically, and it's a nice one if you're a high earner or if you have loads of cash sitting around. So gilts, which as a reminder are UK government bonds, are completely tax-free of capital gains tax. Any capital gain you make on a UK gilt is exempt, which is why people often hold them in general investment accounts or GIAs, where capital gains are normally taxable. And it doesn't matter whether you sell it early or hold it to the end, it's still CGT free. So here's the quirk: if you buy a gilt for less than £100, for example, the 0.125% 2028 gilt you can see here, and you hold it until it matures, it still pays you back the full £100. So that gain from £94 roughly up to £100 is a completely tax-free capital gain. Now, the interest or the coupon, that is still taxable as savings income. That's not exempt. However, in this example, as the coupon is only 0.125%, you'll be earning very little in interest from the bond. And it's the price gain that is exempt and tax-free, which is why for higher earners who have already maybe used up their ISA and pension allowances, a low coupon gilt bought below face value can be a really tax efficient way to essentially hold money and make capital gains. Most of your return comes as that tax-free gain instead of taxable interest. To be clear though, you're overall not earning more. Unfortunately, there's no dark arts here, which happens of course when Arsenal take corners. It's the same return, just in a more tax-friendly shape as capital gains rather than the interest or savings income. It's actually a lovely little quirk and it's completely legit. I will flag though, this sort of thing probably only really matters once you've already maxed out your ISA and pension, because of course inside those wrappers none of this tax applies anyway. Okay, that was a cool little tangent, or in my opinion, anyway. But now it's time for the main event. Should you actually add bonds to your portfolio? And this is why I want to show you the real numbers because you'll see quite clearly there is a proper trade off. Let's start with the long run. There's a brilliant bit of research, the UBS Global Investments Return Yearbook, which tracks returns all the way back to 1900. In the 2026 edition, over that period from 1900 to 2026, US shares have absolutely hammered bonds. After inflation, shares returned about 6.6% a year, bonds about 1.6% a year. That gap is massive, especially when compounded over that such long time frame. Those numbers are on screen now. Although, of course, this is from a US perspective. There's no UK specific graphs in the 2025 edition, but there was in the 2024 edition. You can see in the bottom two charts here, the findings are fairly similar. In real terms, UK equities now have outpaced bonds by around 4% a year, which once again is massive when compounded over a 100+ year period. So that's point one. And it's the whole reason why I think people hesitate on bonds, myself included, because over the long run, adding bonds lowers your expected future returns and historically by quite a lot. But of course, that is not the end of the story because the reason people hold bonds, arguably, isn't about maximizing returns. It's about the ride and making that ride smoother over time. So using the same bit of research and now a classic 60-40 portfolio where 60% is in shares or stocks and 40% is in bonds, that sort of portfolio, the 60-40 split, has never fallen more than about 52% from peak to trough since 1900. Now, that sounds quite alarming, a 52% drop. That was after the Wall Street crash and the Great Depression, so nearly 100 years ago. Modern drawdowns have been a lot smaller. 2008 was the big one at roughly 30% from top to bottom, and the dot-com crashes and 2020 COVID crash were also similar but smaller than the '08 crash. Whereas shares on their own have lost more than 70% in real terms before. Once again, that was also the Wall Street crash. And once again, the modern drawdowns are a lot smaller, with the dot-com crash and '08 crash being the big ones, but still shares dropped in these cases by over 50%. So that really is the trade-off in one line. Bonds have historically smoothed the ride and made those worst days and big crashes less brutal, but they lower your end result. Let me make this more real though, the UK example, because I know the 1900 stuff and talking about the Wall Street crash feels a little bit abstract, and it was a long time ago. So Vanguard have their life strategy funds, which are just ready-made mixes of stocks and bonds. There's a version for every level, from 100% shares all the way down to 20% shares and 80% bonds. They all launched back in 2011, so we've got a decent 15-year track record now to look at, and this is all in pounds. And this chart really on screen sort of says it all. The more bonds you hold, the lower your return has been since 2011, and it's almost a perfect staircase. The more bonds you add in, the lower your returns were. And just in the extreme cases, comparing the top and the bottom one, the 100% shares fund has returned 300% more than the 20% shares one. But now the flip side, because this is really arguably the whole reason why bonds exist, that same staircase works in reverse when markets fall. In the 2020 crash, for example, the more shares you held, the harder your portfolio dropped. The all shares fund 100% stock LS100 fell around 20% from top to bottom, whereas the 20% stock 80% bond one, the LS20, fell just over 7%. And that's the trade-off. More shares, potential more growth, but larger drawdowns. More bonds, most likely a smoother ride, but lower expected future returns, looking at the historical data anyway. The 60-40 investor gave up a chunk of growth from stocks for that steadier ride by holding bonds. But there are a couple of very important points to make here. Firstly, if you are younger and you've got a longer time horizon, I'm talking 10+ years, then hopefully you should have a larger capacity to take on risk because you can ride out the ups and downs in the market. Although, of course, that does depend on your personal risk appetite. If a 25% drop in your 100% stock index fund would cause you to panic sell, then it's probably better to have a 60-40 approach, or whatever suits you, if it will actually help you stay invested, because staying invested is the most important thing, even though, of course, by using a 60-40 approach or whatever split you go for, you probably will give up higher returns. Secondly, that steadier ride actually isn't guaranteed either. 2022, relatively recent, is the perfect example of this. Inflation spiked, Central banks hiked interest rates hard to fight it. And remember that seesaw, when rates jump up, the price of bonds you already hold drops. That is exactly what happened in 2022. So bonds had their worst year on record. Global bonds fell around 16%. And the killer here with this specific case is that they fell at the exact same time as the stock market did. So the whole reason you sort of hold a 60-40 portfolio, for example, with bonds zigging as shares zag, as people like to say, just didn't happen. Both went down together in that example. And that's probably the real risk with bonds. It's actually probably not necessarily a normal stock market crash, because usually that stock and bond trade-off holds up. It's actually inflation. Now, shares aren't a perfect inflation hedge either, to be clear. They absolutely can fall in an inflation shock like they did in 2022. But over the long run, they have beaten inflation because companies can put up their prices and grow their earnings over time. Whereas a fixed coupon bond or even a pile of cash in your bank account can't do that. They get destroyed when inflation spikes. And 2022 wasn't a one-off. The 1970s were actually far worse and lasted years. UK inflation hit around 25% in 1975. And for most of that whole decade, shares and bonds both lost money in real terms at the same time. The classic stock and bond safety net just unfortunately doesn't seem to hold when inflation is the one doing the damage. So that is probably the genuinely very unlucky scenario to keep in the back of your mind. You hold your nice balanced mix of, stocks and bonds, the two different halves, expecting them to offset each other. But if inflation does spike, they actually both could go down instead of one saving the other. It's not common, but it does happen occasionally. And it's probably the one thing that bonds can't really protect you from. So once again, bonds are steadier most of the time, but they're not just a magic safety blanket. And the 70s and more recently 2022 prove that. So the big question then, should you invest in bonds? The honest answer, whether adding bonds is worth it for you, comes down to your age, your time horizon, your actual goals, and honestly, probably most importantly, what you can stomach when your portfolio is down, which is your risk tolerance. Before I tell you how you can actually add bonds to your portfolio, a fair question at this point is, why bother with bonds at all when your savings account or a money market fund is paying you a decent rate with less risk to your money? The real reason is that these rates are ultimately variable, whereas a bond locks in today's rate for years. So it provides longer term income and more certain income at a specific and potentially maybe higher rate. And if there was a crash, bonds tend to rise as rates get cut to tackle the crash, which can help to offset a fall in stock market. Of course, not always, like in 2022, but usually. Whereas cash or cash-like investments just sit there. So cash definitely still wins for short-term money and for your emergency fund, but for longer-term money and for smoothing out a crash, that is where bonds can come in handy. Right, let's say you've weighed all that up and you do want some bonds. How do you actually invest in them as a UK investor? There are a few ways. The easiest for most people is a global bond fund. One fund holding hundreds, if not thousands of bonds from all around the world. GBP hedged funds are also hedged back to the pound, so you're not taking on as much currency risk on top. And that's actually an important point. Currency swings do add a bit more risk to bonds than to stocks, which is why bond funds, global bond funds, are typically hedged, whereas global equity funds usually aren't. Vanguard's Global Bond Index Fund is a popular low-cost example. It invests into over 14,000 bonds for a low 0.15% fee. However, it's a mutual fund, not an ETF, so it's not as widely available. So another option from Vanguard is Vanguard's Global Aggregate Bond ETF. The ticker symbol is VAGP or VAGS, depending on whether you want an income or accumulation version. This invests into a slightly lower number of bonds, but still over 12,000, and has an even lower fee at 0.08%. Both of these funds have quite similar holdings, investing primarily into AAA, AA, and A grade bonds, with a focus on maturity from 1 to 10 years, and with over 50% being government bonds, which are safer than corporate bonds. The yield on both of these funds is currently around 3.5% at the time of recording. There is also this option from iShares, which tracks the same underlying bond index, but it is even more bonds, just under 20,000 for a very low 0.1% fee. But when it comes to the GBP hedged version, there is only a distributing version and no accumulation version. SPDR or State Street also have their own version. And this tracks just over 10,000 bonds for another low fee of 0.1%. Although the same thing here, there is only a GBP hedge distribution version. If you specifically just want UK government bonds, there are UK gilt funds you can invest into. VGov, VGOV from Vanguard, and IGLT from iShares are the common low-cost ones. Same idea, but the funds just hold UK gilts. This is Vanguard's version. It currently has a high yield of over 4.5%. And this is the iShares one. It's very similar, a similar fee, similar number of gilts, and similar yield, though it is much larger than the Vanguard one in terms of its assets under management. As you can see, the yield on both of these global bond funds and these UK gilt funds are quite high, and I think it's why bonds are coming back into the picture, being talked about a bit more, because this makes them more attractive. If you're holding in a general investment account, a GIA, then there's buying individual gilts yourself. I'll flash back up the free trade screenshot from earlier on in the video. You pick a specific gilt, hold it to maturity, and you get a known return on a known date. Some people build what's called a gilt ladder, which is just several gilts maturing in different years, so cash comes back to you at regular planned intervals. This is also where that CGT free quirk from earlier comes in and can be quite handy for you depending on your situation. HL, Hargreaves Lansdown, offer the widest range of individual gilts. Free Trade offer some and are actually a lower fee platform. And there are other UK platforms that offer them too, such as AJ Bell and Scottish Widows. An important point to make here, an individual gilt has a maturity date. You hold it to the end and you get your £100 back usually on a known date, whatever happens in between. A bond fund, on the other hand, never matures. It just keeps rolling, buying new bonds as old ones drop out. So there's no set date where you get a fixed amount back. Neither is better or worse necessarily, they just work slightly differently. And the fourth route, which normally suits a lot of people, is just letting an all-in-one type fund do the whole thing for you, which is those are life strategy funds from Vanguard that I mentioned, where it's a set split of stocks and bonds, or a target date retirement fund, which holds the stocks and bonds in a set mix and rebalances automatically. With these examples, you don't have to manage that split really as much, if at all, so it's probably the easiest approach. Although the main risk of this approach, particularly with those target date funds, is that they could move you too much into bonds too soon, and you could leave a lot of money on the table. I found that this happened to me in both of my workplace pensions. I'm not going to tell you which of these to pick because that's ultimately your call, and it really depends on what you're after specifically, but those are the available options for us as UK investors. So after all that, what do I actually do myself? I'll be straight with you. Right now, I hold 0 bonds. I'm 100% essentially in global index funds and ETFs, almost 100% in global equities. And the reason is really the maths that we just went through. I've got a long-term time horizon, decades hopefully, and I'm still very much in the building or the wealth accumulation phase. The volatility of the stock market genuinely doesn't bother me too much while I'm still adding money every single month. In fact, perhaps counterintuitively, a crash would probably be a good thing for me because I could hopefully actually buy the same global index funds at lower prices and make more gains over the long term. For me right now, the growth matters more than a smoother ride. That's my personal preference. The bigger volatility, the scary down years, I've actually had a couple of crashes I've been through myself. I actually sort of see those as good buying opportunities whilst I'm still paying in. Saying all of that though, would I ever add bonds to my portfolio as I get older and get closer to actually needing the money? Genuinely, I'm not sure. The textbook, of course, says you should shift towards bonds as you approach retirement, and there is a real sensible reason for it because of the sequence of returns risk. Basically, a big crash in those first few years of you living off of your investments while you're just starting to sell the investments to fund your life can do permanent damage in a way that wouldn't happen whilst you were still saving and working. Having some bonds means you shouldn't experience as much of a big drawdown as you approach retirement or in those early years of retirement. That is, I would say, the strongest case for bonds. It really does depend on your other income, your overall financial picture, how much you rely on your investment portfolio to fund your annual expenses. If you're making, I don't know, £20,000 per year from a DB pension or from property rentals, or you've even hit the age where you've got the state pension, then you might be able to take on more risks with your investments. Whereas if you are fully relying on your investment portfolio for everything, then you might want that portfolio to be a bit more risk averse. Where I land for now, if I ever do add bonds, I think it will be later rather than earlier. Maybe not at all, given the long-term low real returns. But if I was to do it, I think the easiest way, in my opinion, is to simply hold a global bond fund inside my ISA and SIP wrappers. So that's what I'd probably do. And if I wanted even more bond exposure on top of that, or essentially more cash on top of that, I probably would then hold those UK gilts inside of a general investment account and create some sort of gilt ladder. Although I'm a long way away from that, and it definitely is a bit more complicated to set up. But honestly, I'm not 100% sure. So ask me again in 10 years time and I might be able to give you a better answer. I'm not anti-bond though, to be clear. For loads of people, especially people nearing retirement, such as my parents, they definitely make complete sense. It really is a personal decision. But for me right now, where I am in my sort of wealth accumulation phase, trying to grow my pots as big as possible, it's a no from me for now. Bonds aren't the most exciting topic in the world, I'll give you that, but they are actually very important from both an individual perspective and a countrywide perspective. So if you listen all the way to the end, thank you. I really appreciate it, and I hope it's been helpful. The trade-off underneath, I guess, all of this, and I know I've mentioned it a few times now, is growth versus a smoother ride. And it is really one of the most important decisions you will make as an investor. And that split between stocks and bonds, your asset allocation, essentially helps to determine what your long-term expected future returns will be or could be, and how large those drawdowns in your portfolio might be as you're building your wealth up over time. So it is actually worth understanding it, in my opinion, rather than just copying some rules of thumb that you may have seen online. And if you're currently investing, you might be thinking, is now a bad time to invest? Probably not. But I'll link the video on screen next, which I pulled together recently. That has the full details on whether now is a bad time to invest and whether you should invest at all-time highs. The video will be on screen. Click it now, and I'll see you in that one next.